Good morning, good afternoon. I don't know where it is, wherever you are in the world, wherever you listen. I know what it is right here. It is noon and it is TakeStock Live. And my name is Sam Evans and TakeStock Live is brought to you by StockAbility.com. I hope you're having a fantastic week and happy April, 1st of April. I'm not going to be cliched. I'm not going to do some April Fools, or will I don't know. But more importantly, it's the start of a new month. Q1 of the financial year and the overall calendar year is over. Can you believe it? 2021 is well underway. And what does that mean for the stock markets? Who knows? What does that mean for our lives? Who knows? I feel like so much has happened, yet so little has happened. It has been a strange one, but all I do know is, like we said, Q1 is over, and I hope it's been a healthy, happy, and safe Q1 for you up until this point. Today's show is all about diversity. I'm going to be joined today by my good friend, colleague, and partner at StockAbility.com, Mr. Ryan Watkins, and we're going to be talking about diversity using ETFs. We are big fans of ETFs on TakeStock Live, and we want to talk a lot about that diversity. To me, they truly are a multifaceted tool and something that people do not pay enough attention to. And it's great to have somebody with the knowledge and the know-how, like Ryan on here, who can kind of fill in the blanks where I can't. I like to keep talking, and as you know, I do. But there's so many moving parts to all of this, and it's so great to get, a different level of expertise coming on here, and just a whole nother level of expertise, on here to just really discuss that and get into it. So Ryan is going to be joining us shortly as well. The show is live, and it's great to have you here. I know many of you do like to look at the recording of this, and if you are looking at the recording of this, thanks for taking the time out of your busy schedule to see what we do and who we are, and just basically joining in the fun as well. If you are joining us live, we are here live on Facebook, and you can type your comments and questions in real time as you're viewing this through Facebook page. I check it all the time. If you had seen me glancing down and looking down there, guess what I'm looking at? I'm looking at your comments as they're coming in live on the screen as well. So we are definitely in tune, and being live means that sometimes we make mistakes, and this is what live broadcasting is all about. That's why we love it so much as well. Remember, this show will be, however, rebroadcast as a recording here on the Facebook Live StockAbility channel, and also you can find us on our YouTube channel as well. Go ahead, by the way, and check out that YouTube channel. The whole team, including myself, has been really active over the last few weeks, posting daily trade ideas and tips, and we've got some really exciting new things appearing on the StockAbility website next week, and also something really, really cool happening at the end of this month. And yes, I'm talking about April, if you haven't realized we're in April yet as well. All right, excellent. So let's see where we're at. Let's see what's going on. Where's the news at right now? Let's just talk about the big headlines in the pages today right now. Stocks were set to rise after the Dow S&P at their best month since November, and as it stands right now, S&P 500 is literally knocking on the door of 4,000 points, up 31 on the day, up 0.78%. We're going to go take a look at those charts in just a second. The futures started high, had a little bit of a sell-off in here, but it seems like today the S&P is the breakout right now, which has been the sluggish, slow kind of gainer over the last couple of weeks as well. But things are looking great in the market. Are we set for a happy Easter? Wouldn't surprise me to see us closing on new highs. Historically, it does seem the markets end up rallying on the opening day of the month as well. 10-year Treasury yield dips below 1.7% after the jobless claims data. Okay, so we're still seeing a lot of pressure on that market there. The Pfizer COVID vaccine, 91% effective in updated trial data. Okay, there we go. A lot of people are happy to be getting those shots in the arms as well. I'm still taking my time before I put more chemicals in my body. More chemicals in body? That would suggest I put lots of chemicals in my body today. No, but maybe in the past, but not anymore. I'm a clean living man. I'm not putting that in until I really have to as well. Associated Press, firm at center of Johnson & Johnson's COVID vaccine woes as a series of citations hits as well. Okay, so again, a little bit of kind of grey area on what's going on there about a number of doses of Johnson & Johnson's vaccine being ruined. Okay, not a great thing as well. Hate to hear that happen because there are people in desperate need of those shots as well. And finally, after an infrastructure announcement, massive multi-trillion-dollar infrastructure and a major investment in America, our President Joe Biden said as well, he's going to be holding his first cabinet meeting as well. From a news perspective, kind of dull, really, if you ask me. You know what's more fun? You know what's better to be looking at here? I'll tell you what's better to be looking at. It's better to go and actually look at those charts. So let's grab those charts right now and go take a look and see what we can see. What are we looking at here right now? So here's that important point. I'm going to zoom in so you can see it right now. But there we go on here. 4,000 is the high that we put in to the button. on your S&P. Right now, actually, guys, if you can't already see this, looking at the S&P futures right now, this is what we're focusing on, is the S&P futures. The uptrend, as we've been talking about, is still happening on here. That is not going anywhere. The uptrend is still in play, it seems, as the market's still doing its thing right now. No real reason to worry about it. And again, I think, not really surprising considering the kind of week that we've had moving into the market as well. What else are we going to be looking at here? Let's go take a look at our Dow Jones on here and we'll see what that is. Dow Jones, this morning I was trading the Dow, actually made a little bit of money on the short side of things on the Dow Jones today. But now it seems on here, let's just zoom in so we can see this on here. Dow Jones still hasn't regained its highs of 33,134, but I'm really glad I covered those shorts today. I was getting short on this market and I was really looking at 32,900 as a target, which I did. I posted that actually. If you go to my Twitter feed, you'll see a video of the trade I did this morning. Just a quick scalp. I got to say, not really interested in what I'm seeing on the market. I've really been playing this range over the last couple of days. The Dow just lagging behind. I'm not crazy excited about the fact that the market's popped today on the S&P. We're still lagging behind on some of the other indexes. This is my weapon of choice. I love the Dow Jones. But really, guys, if you are trading for the rest of the day, you've got just under 4 hours of the market. I wouldn't expect a whole lot to happen between now and then. I was done in 9 minutes today. Okay, I was out and done by about 9:39, hit my daily target, and I'm done. So again, typically on days like this going into holidays, and I'd love to get Ryan's opinion on this, I typically just stay out the market and just do my thing, get in and get out and move on and do something else, basically. Let's go take a look at what else we got. The big one, let's go take a look at the NASDAQ, the mighty NASDAQ, which to me hasn't really been that mighty. Big gap up today, but facing massive resistance right here in this region as well. That's the big line in the sand for me, this current area that I see on the NASDAQ. This is the current area for me where we've got to see a pop. There are unfilled gaps a little bit higher, but, even that push on the S&P hasn't dragged it. Tech's took a big slap over the last few weeks, and we're trying to recover, and it's really kind of putting a lot of cushion on there. Maybe the individual stocks, maybe some of those FANG stocks need to step in and help push the NASDAQ up, but not a place I'd be jumping into the NASDAQ right now, especially after an outside day, gapping right into those areas. There's a lot of room to the upside where this market needs to retrain. And I will say this, if the overall stock market does start to get a little bit weaker, NASDAQ, guys, is one of the things I'm going to be looking at because that's, to me, a real laggard and not really been performing the way we'd like it to see in line with the S&P and the Dow. And we've talked about this a little bit because there seems to be a more of a wider focus going over to those value plays rather than those growth plays. Remember, the tech stocks all about growth, growth, growth. Value in the Dow and S&P. You can see the same thing. What's the Russell here? Russell 2000, all about growth. And maybe it was done. This thing had a monster March in the open part of the month and then gave it all back. If you were an investor in that kind of tech, look what happened to you. Start of March, fantastic, gave it all back and only kind of recovered half of that right now. Is this a telltale sign that we're due a little bit of a correction? I gotta say again, on my bearish watch list right now, Russell is on there. NASDAQ and Russell. Now, this doesn't mean I'm writing off individual markets. I class Apple as a value play right now. There's some of those big ones, but those smaller tech-based growth companies, to me, I just don't feel comfortable jumping into those. I'm gonna go with the stalwarts, the cart horses, as we call them back in the UK. Kind of put my money behind those kind of things right now, staying a little bit safer. A lot of selling pressure in the 22,000 points right now area, and a lot of key monthly levels have been established as well. To me, there's a lot of work to do on the Russell. So there's going to be on my bearish watch list. NASDAQ's going to be on my bearish watch list, but I will be looking at markets like the S&P and the Dow for those ones to kind of put my money into if we do see a little bit more strength coming into the market that way as well. All right, so that's the major markets on there that we're seeing on the equities. Let's just go, we've got quick time on here. Let's go look at crude oil. You know me, I have been so bullish on crude oil. After hitting those targets of nearly $68, what am I thinking about crude right now? Not a lot. This is an ugly market. Ugly market. Right now, when I see price action like this, I don't want to do anything right now. This thing's either going to rally back to these highs or it's going to hold these lows. And until this thing gets to some extremities, I'm going to just sit back and I say, hey, this might be a great time to play some non-directional plays on crude oil. Depending on what the volume is in the options market, there could be some very cool things you could do on that. Otherwise, go find something else to trade. I don't like to force a market. And right now, it feels like any trades on that is just forcing. Maybe if you're a consummate day trader, you could find some opportunity on that. But right now, crude, nah. I'm not really that bothered about it. Not really bothered at all. So I've given you my little crude update. We are going to talk about gold as well a little bit later on too in the market. But again, all eyes, like I said, on that S&P 500. So let's go back over to those futures. Need it there. Highs just put in again of now 4,000.75. I mean, it's a good day for it. But again, the other indexes aren't really doing the same thing. I'm not crazy excited about it. I'm not jumping up and down. I'm done for the day. I'd rather be talking about ETFs and some entertainment and enjoying the rest of my day. And I'm not going to do it on my own. What I'm going to do is I'm going to bring my guest on, my special guest, my honored guest, Mr. Ryan Watkins. There he is. How are you, sir? In the penthouse, rocking and rolling, my friend.
How you doing, Sam?
I'm good. I feel like I need a drink. Here we go. Always when I open that show, I feel like
more chemicals in your body there, Sam?
More chemicals in my body. You know what?
Liquid chemicals, huh?
We were all young once, right? So it's all good. I live a pretty clean lifestyle right now. I don't know about you, Ryan, but I found in the world that we live in, especially in trading, and I found the mental discipline that needs to go with that. And you know me, I'm predominantly a day trader more than anything else. I'm a very lazy day trader because I like to get in, get out, and typically do it. But, you know, I find I need to be very focused, and I try to live a pretty clean lifestyle. And I find, you know me, exercise mindset, I feel goes hand in hand with this too. So those days are long behind me. What about yourself? What's your take on that, my friend?
It does help when performance, no doubt. And I have my beverage of choice right here.
Very nice.
Some of Georgia's finest water.
Beautiful, excellent. I would say like a peach tea or something like that.
Yeah, no, I'm not much into the sweet stuff, which is funny because, you know, in the South, it's all about sweet tea. So everywhere you go, it's sweet tea. And I'm like, I don't want anything to do with that sweet stuff. Like, just, you know, I don't know, call me old fashioned, I guess.
It's so good. Now, old fashioned, that's a drink I like. If that's what you were, I like. And that's something. But as the warmer weather comes, I tend to back away. Like I say, look, listen. At the end of the day, I'm all about, like I say, trying to keep things, you know, from a performance perspective and keep it clean and neat as well. And I think you do need to in this business as well. But a little bit of everything can do you good. You know, it's everything in moderation. And I think that segues beautifully into what we're talking about today. You know, a little bit of everything, diversification, and what a wonderful vehicle we could use in ETFs as well. You are a big fan, aren't you, Ryan, of like longer term plays? You're a big fan of asset allocation. You know, you've been literally winning over students at StockAbility with your, you know, Wealth Wednesdays that you now do on there as well. And I thought, you know, what a great opportunity to talk about ETFs, because it's amazing. I still get so many questions about them, and it's not like they're a new thing. Are they? They've
been around a very long time.
Yeah. What do you tell it? For anybody who's not sure about an ETF or never heard of it or wants to make sense of it, how would you best describe it? Because you're great at just taking these concepts and breaking them down to an easy to digest way.
The biggest, I guess you would say, competition or comparison that someone uses with the ETF is with mutual funds. Because think back to, you know, when you and I are right about the same age, young. Yeah. And so if we go back to when we were younger, in our prime, now that's a good age right there. In our prime. I like that. Good. And it's a long time to last, right? Yeah.
I'm staying on top of the mountain. I'm staying on top of the mountain for a long time.
Just camp out there. Just camp out. Yeah. So when back in the day, in the old-fashioned days, people used mutual funds, and they still do. It's a big business. It's absolutely huge, in fact. And
well, how big compared? Sorry to interrupt you, but how big, like, compared to the mutual fund industry now? Like, are we like kind of competing? Are these two industries competing, or is one still heavily leading the other?
You know, I would say about 10 years ago, it was mutual funds absolutely dominated. Right. You know, asset allocations, retirement funds, endowment funds. I mean, you name it. And nowadays, it's really the ETFs have really pushed aside the mutual fund industry or business, and they're still doing well, by the way. Mutual funds are still there. They're not going away anytime soon. Yeah. But the ETFs have really taken over and become the investment of choice for many reasons. You get tax efficiencies, you get the ability to get in or out on that same day at any time during the day, whereas mutual funds, you're stuck until the close, you know, and you're marked at that, what's called the net asset value. So they're not as liquid. ETFs are more liquid. You can trade options on ETFs where mutual funds you cannot. There's much more diversity in ETFs. I don't know. I bet mutual funds maybe around the same, but ETFs is just bottom line. It's a better mousetrap. You can day trade them. You can swing trade them, options on them. You can long-term diversify in your portfolios with them, asset allocations with them, you name it. You got worldwide ETFs. You have niche ETFs actually. So for example, there's been a lot of talk about the GameStop and the gaming companies and stuff like that. There's actually ETFs that specialize in game-oriented companies, game-oriented stocks, like video game companies and stuff like that. And so if you were into that and you really know that industry well, or you think, hey, that's the next big thing, then you can actually invest in these ETFs, these little niche ETFs. In that case, gaming stocks, or, for example, here's another one, water. Let's say, I think water is the next big commodity, and that's just where it's going to be. It's going to be the next oil market or something like that. Well, you can invest in the water ETF or ETFs. There's more than one.
Wow.
So there's all kinds of things that you can invest. Almost like, if you can think about it, there's pretty much an ETF out there these days for it. That's how ridiculous it's gotten.
So
now, there's good and bad about that. I mean, it's like, hey, cool, we can invest in whatever you're interested in, but that's not always necessarily a good thing, because just because there's a water ETF or a who knows what ETF out there, it doesn't mean it's liquid, meaning it doesn't have enough volume for you to trade in, to get in and out.
Yep.
It doesn't mean that it's actually a good investment vehicle for someone to invest in or to trade. So yes, there's many, many out there, tens of thousands upon thousands of these ETFs. But we really need to focus it down to what's really appropriate for someone.
Yeah. And so basically, I think a good way of describing it is, it sounds like these things, they do everything a stock does, but more.
Yeah, absolutely right. So that's a great way to describe it.
When we talk about now, stocks and mutual funds, what I'm hearing is, well, why would I bother with a mutual fund? Because aren't there the fees that also come with those mutual funds? Unlike
pretty high fees normally. Yeah. With I'll give you an example. This was years ago. My aunt gave me her portfolio, her retirement account, to invest for her instead of her financial advisor that had been doing it for about 30 some years, almost 40 years. And she said, Ryan, I'm retiring. And she just didn't trust the guy anymore. She trusted me more, and says, I want you to take over. And so I said, okay, no problem. So I got her statements. I went through all her statements. She had all mutual funds, and many of them. And I was going through and combined, get this is absolutely nuts. I added all the fees up. The average was for the whole portfolio was 6.3% average. Wow. Now that includes her financial advisor fee also. So I'm putting that in there too. So between the financial advisor, the mutual fund fees, and I emailed the advisor, and I said, hey, what's going on here? And he's basically like, well, we're not charging those fees. What are you talking about? I'm like, I'm looking at it right now.
They tried to deny it.
What he didn't
they were
trying
to deny the fees.
And I don't know if he just was straight up denying it, or just if he was ignorant, meaning he just didn't know.
Right.
Because I was doing a ton of due diligence. I was actually going into every single one of those mutual funds, like the prospectus and online. And, there's that kind of that joke in that movie where, who was it? Dr. Barry was reading all the prospectuses of all these real estate funds and all that kind of stuff. And the guy says, nobody reads those things. Not even the lawyers read it. He's like, I read them. I was like, well, I didn't read the whole thing cover to cover, but I read the part where it has the fees. And it also, there's websites out there that you can go to find the hidden fees of these mutual funds. So by the time I got the advertised fees, and then the hidden fees, found those, and added to it the advisor fees, all of a sudden now it's 6.3%.
Scary.
And that was staggering. So I show my aunt this information, and I said, and she could tell the look on my face. She's like, is it bad? And I said, it's bad. I says, you're getting charged 6.3%, but here's the good news. We can turn that around immediately.
Yeah.
And I could not only save you that 6.3%, but we can put you in very low cost, low fee, highly liquid, good performing ETFs instead of the mutual funds. And that will save you about a little over 6% right there. There's still some fees on the ETFs, but it was about, like a 1/10 of 1% to about, like anywhere from 0.1% to 3%. That was the range of the fees for the ETFs, and some of them are even lower than that. And so I said, look, I could save you right now about 6%, and you'll gain not only in the performance just on saving on the fees, but you'll gain on performance because I have better asset allocations for you than what this guy's put you in. Which this guy kind of just put her in something and said, adios, goodbye, I don't care, on to the next client. That's really unfortunate.
And that's unfortunately the tail of the industry, though, isn't it? I mean, that's it. And, we talk about 6%, 6.5%. Most people you meet today in retirement, they'd be happy to be getting that consistently every single, just alone. And then that's just what you're giving back.
Right.
And then you think, look and say, well, I'm only getting about 4%. And it's like, well, you know what? You're actually kind of getting a gross of over 10% there, which is more than adequate for your needs, because that adds up. And then they can't. And on top of that, I think this is what always gets me is then, you've got the thing of, well, how protected are you if it all goes wrong anyway? If you're in these mutual funds, you're paying the fee, but how much protection are you really getting? And what I like so much about the ETF is you can put a stop loss in. You can maybe even do an option to protect it. There's just so much you can do with it. Anything you can do with a stock, you can do with an ETF, right? I mean, that's really that's the nutshell.
Yeah, there's so much more flexibility, and we talk about diversity. It's not just diversity in asset class; it's diversity in strategy. It's diversity in protecting your assets under management, protecting your money. And like you said, you could do options on these ETFs. For someone that knows how to do that, there's some real simple things you could do to protect yourself on these things. And like you said, you could put a stop loss on it too. With mutual funds, you can't put stop losses on. So there's a lot of things that you can do with ETFs that you just simply cannot do with mutual funds. And again, it gets us back to it's a better mousetrap.
Absolutely. I just put up a chart right now of the S&P futures. Just for anybody looking at the chart, which is what I always quote. But let's go and take a look at that. You can outright trade that. Let's go and look at one of the most, if not the most popular ETF out there, the SPY.
There it is, number one.
Also known as the spiders. You can see the ticker of it right there in a little symbol of it. Now you'll see on this is the same chart pretty much. Okay, so if we just flick between the two, of these, there's your S&P futures right there. Okay, and then we go over to the SPY. Same chart. Okay. Difference is this trades just like a stock. These futures, this will be moving pretty much in line, in parallel, with the S&P futures, except the S&P futures trades overnight. And I don't want to confuse anyone on that. But this is a great vehicle because, we could go look at the index right now, couldn't we? We could actually go and look at the SPX, okay, which is the index. And then you've got that, which is what confuses everybody. You've got the index, and then you've got the futures and so on. But, if you want as much liquidity as possible, that SPY is going to give you everything. And to me, it baffles me. When you look at this, look, let's go over to the VINX, okay? Actually, the VINX, let me do this. It's actually let me just take it, the Vanguard Institutional Index. Let me just find it in here. I'm just trying to remember what the ticker is for the Vanguard Institutional Index right now. I thought it was the VINX, actually. Yeah, there it is, Vanguard Institutional Index. Hit the enter on that, and let's just see if it's going to give me the data on here. Because I want to get a little bit more data on here. Oh, there you go. Perfect. There's my Vanguard Institutional Index, the VINX, Ryan. Okay. For some reason, it wasn't giving me a clear bit of data on the daily charts. Is because, well, look, the daily charts is the problem. It doesn't move. So you have to really look at this on a weekly chart. Okay. Because the problem is, now look at that chart. That's a daily chart of the VINX. Okay. Which is the Vanguard Institutional Index, which I believe, Ryan, is the current, last time I checked, the greatest amount of holding, the most held mutual fund out there right now, at least in the US. It pretty much 100% tracks the S&P 500. Now you'll notice, well, why is there only one bar here? Well, because you get such little movement on here, you don't get any bars because you don't get to go in. It's not tracked in real time. You just got the open and close price, which jumps every day. So to actually see it, you have to go to a weekly chart to see the movements of it. And that's what you were saying. You can only get in and out of these things at 4:30 in the afternoon after the market's shut when you're trading the VINX. When I look at the chart there, you can see it moving. You can see it moving in this respect, right? If I go to the SPY, though, same chart.
Yeah.
What's the difference, though? I can buy and sell when I want to sell. I can put stop losses in. I can do options. And on top of that, Ryan, I don't have to pay any fees. I sit back and I go, why would anybody go into the VINX when they could actually be going straight into the S&P? What's your thoughts?
Because they don't know.
It's as simple as that. People don't know what they don't know. That's all.
Right? They just don't know. It's like you go to the grocery store, you see a gallon of milk for $5, and in the next aisle you see the same gallon of milk for $2.50.
Yeah.
It's like, why would you pay $5? Well, because it's right there. They just don't know.
Because it's easy.
The one on sale is in the other aisle, and it's the same. No, not a worse expiration date either. It's the same thing, you know.
It's like, you know, I mean, it is, and it's crazy. And now, look, when you see that, it's so interesting when I pull up that VINX right then, you can see it on that weekly chart. But again, if you're wondering why on the daily chart it looks like that, it's because, guys, all you've got is these dots, because you can only get in and out at the price that it opens or closes at 4:30. So it's not going to give you any real candles. The only way you can ever see that at most is on that weekly chart as well. You put together a great list, because here's what I love about this. We want diversity. People think, Ryan, that they're diversified when they're in the S&P. But I say to you, you're not diversified when you're in the S&P. Why are you not diversified? Well, you've got, 500 companies, and they're all different companies, but they're all in one basket. So it's like having 500 different eggs. Duck eggs, quail eggs, goose eggs, ostrich eggs, but they're all in one big basket. You drop the basket, they're all going to break. I don't care what you say. You're not in separate baskets. So I feel that with the great thing with the ETFs, you can get ETFs and other things, like you said, water, bonds, real estate, oil, gold, and so on as well. That to me is real diversity, wouldn't you say?
It is. It's non-correlated diversity, and that's really what if someone's looking for diversity. I used to watch this like on Jim Cramer's show, where someone would call in, "Are you diversified?" And they'd name their stocks, and he'd say, "Yes, you are. No, you're not." And it was interesting that they'd all be stocks. Stock is a stock.
How are you diversified if you're in just stocks?
Yeah, you're in complete stock. Like, you're nothing but stocks. That's not diversity. Those are different stocks, but they're all stocks. They're all tied to the economy. And yes, there is some portion of, their own company earnings and stuff like that, but it's also dependent on the economy, the sectors, the industry that they're in. Yeah. They are all tied together in some form or another. When the economy drops, so does the stock. That's not true diversification. So if someone's looking to be diverse, like truly diversified, you need to get non-correlated diverse opportunities. And and like you say, you got some real estate, some equities, some bonds, some gold, some this, some that. And we'll actually get to it in the some of the pictures here we're going to show in just a moment. But there are really 4 different types of, call them economic climates, what can happen in the economy.
Yep.
And if someone's looking to truly have that diversity, they need to have something from each one of those quadrants.
To truly
and that
be
is really the true diversification, if that's really what they're looking for.
Well,
not so much from a trader's perspective. If someone's just going to trade, they don't really care. Like, I don't care what the market is, I'm a trader, But if they're investing and doing some more longer term stuff, they got to have that diversity. They just have to.
As a day trader, it doesn't. I mean, I don't worry about being diversified. One day I'm long, one day I'm short. But as a day trader, it doesn't matter. That's why I think people, we do a whole section on this on a new program we've got, our trading and investing orientation, where we talk about the traditional portfolio versus the diversification portfolio. In fact, we talk all about it in our complimentary webinar. Okay, so and that's fine. It's about picking, like I say, the right action to take and the right tools to use in the right scenario. When you're a short-term trader, who cares? I'm a boring so-and-so. I trade the same thing every day, one thing. I don't care. I just need movement on it. But when I've got a portfolio that I'm more kind of very passive and hands-off of, I want to make sure that, great, I could be buying on this and buying on this, but one's going down and one's going up. So I'm just delta neutral. That's not how it works. We want to making sure we're making money, and then the things that are losing, we're cutting those things off and rolling the money elsewhere. You kindly put together some slides here, which I'm going to cut us out of the screen in just a second.
Sure.
Because we're going to get in the way of this. But I'd love to talk to you about this as well. And Ryan kindly put together these slides for us, guys, so of some really cool things that we're going to look at. So I'm going to just kind of take us out of the picture right now. And let's talk a little bit about this, what we've got on here, what we got. So you've got some categories you put together in here. You want to explain what these are to us?
Yeah, sure. So if someone is interested in getting that diversity and they just don't know much about ETFs, like what's available and stuff like that, then this list will be a great starting point. So you have different asset classes, ETFs for asset class. You have ETFs for a different style that someone might be interested in, like an investment style. You have sector ETFs, like consumer staples, utilities, real estate, things like that. You have fixed income ETFs, commodity ETFs, gold, silver, copper, things like that, oil. Region or country ETFs. You can invest in ETFs in, Russia, Turkey, Brazil, United States, Japan, you name it. Pretty much most countries these days, most industrialized countries have an ETF associated with that stock market of that country. Or you can do a region like the South Pacific ETF or the Europe ETF.
Very cool.
So those are more regional. And then you have niche ETFs, and niche ETFs.
I like the sound of this. Tell me more. I like this.
Yeah, so that's more of a new thing. That's one of the, I'd say, the newest ETFs out there. And that's what I was talking about earlier, where if you're interested in, say, like the gaming industry, you think that's going to be the next big thing. All right, so there's an ETF for that. Or if you think, let's see, like 3D printing, that's still a fairly new technology, and it's been growing over the years. So 3D printing, if you think 3D printing is the place to go and that you want to invest in that because you think that's the next big thing, well, there's an ETF for 3D printing.
Nice.
So there's ETFs for all kinds of things.
And you said water as well, didn't you? I did.
Yeah, that would be the commodity one, I guess. So nice. Yeah, I mean, there's ETFs for all sorts of things, and you have performance-based ETFs also. So that would be more like a momentum style investing.
Yep.
And then dividend-based ETFs. There's a lot of ETFs that just focus on dividend companies or dividend, like high dividend and stuff like that, or increasing dividend companies. There's so many more, and there's more coming out all the time. Every month there's a whole new list of, here's another ETF, here's another one here, here's another one there. And so there's no shortage of these ETFs out there, that's for sure.
There's a ton of them, so that we've just talked about there.
And those are just the categories.
And these are just the categories. And I wanted to share something on here which, is pretty interesting as well while we're on the screen as well. And this is what I was just talking about. And I suppose I'm going to do it this way so, people maybe understand it. One of the big mistakes that people say, especially in traditional investing, say, look, you've got to have your... Let's say here, like when we talk about asset classes, we're going to be talking, and again, excuse my writing, but we're going to have our SPY, our S&P right up here. And they'll say, it's good to have over here on fixed income some bond exposure, right? Okay. And then maybe over here you might have, some gold or something like that. But for most people, it's pretty much these two here, isn't it? Stocks and bonds. And I think the big mistake that a lot of people then make is they split that portfolio. And I've seen allocation like 50-50 on here, where it's like, all right, great. So when your stock portfolio is going up, you're then seeing this kind of drag on your bond portfolio. But it's like, well, it's fine because then when this one goes down, this one will go back up. And it's like, yeah, but you end up just being neutral all the time, which is not what we want. What we truly want here, what is really going to help us, so much more, is when we're in a situation where we're actually got a little bit more diversification, where in this case, okay, maybe I've got some asset class ETFs and I'm riding those things to the upside, but I'm protecting and locking in gains. And then some of those gains, when this market peels off the edge of a cliff, I'm going to bank those gains, and then I'm going to move the money into something like a fixed income when I can buy that low and enjoy the gains on that. So it's more of a transfer of money from one to the other, as well as also holding something simultaneously and some things at different times. Wouldn't you say, Ryan?
That's exactly what we are teaching in our Wealth Wednesdays for the active investing is, if this happens, then we rotate our money in and allocate a larger portion to, bonds, or a larger portion to equities, or a larger portion to gold, or whatever it may be. Once these triggers happen, that's it. Bam, we're out of here and we're into something else. So that's more on the, we call active investing or tactical asset allocation, where we're being very tactical about it. And it's not just a buy and hold approach. For just give you an example, the S&P 500, going back to 1993, if you're just to simply buy and hold, you're looking at about 10% per year. The problem with that is, though, you went through a 50% drawdown on that.
Let's go take a look at a chart for it.
And that was pretty scary stuff.
Let's go take a look at this. And so you look at the S&P. I'm going to just pull up the SPX when I do this, okay? And let's go and bring up the charts together, because it's always great to be able to do this. I love doing this in real time, okay? So let's go back to 1993, you were saying, right? So here's where you are, just around this period here. 1993, you were saying, was it?
Yep.
Okay, right. So here we are. We'll zoom in, and let's just highlight this area here. So actually, let me even go back. I might have enough data on my weekly charts, because this is going back. Yeah, I'm going to have to stick on these monthly charts here. So around this particular time we're talking about, Ryan. So let's just zoom in. And see
right about February of 1993.
There we go. So let's zoom in so we can see it around here. So here's 1993. God, it's so hard to see, isn't it? On here. Look at
so
where
long ago.
So tell us, what was going on here?
So you're doing about 10% per year on average.
Yeah. Yeah.
And, but the problem is, though, I mean, that's okay for an investor. They're probably happy with that for, I think, most people. The problem, though, is that you lost half your value. You lost 50%. And if you look at, statistics going back to, 1890, whatever, however far back we can go with the stock market records, you're getting a 50% loss anywhere from 1 to 3 times in an investor's career.
Yes.
So once you start investing, you should expect your portfolio to drop in half at least once, probably more like 2 or 3 times, though. And that's just half. I mean, it will go to 80, like 70 or 80% drop at least once in your lifetime. That's terrifying stuff. You're like, wait a minute, I built up this account for 30, 40, 50 years of my working years, and then it drops in half or more. I'm not going through that. No way.
Let's go take a look at the NASDAQ for a second, and
that took an even bigger hit.
I mean, exactly.
That took an 80% hit in 2000.
Exactly. The NDX is a great example of this. Go to a weekly chart. Hopefully you can see this, everybody, looking at home. And we can go back and we can take a look. But, if we just go back to this is a great example of it, right? So just so everybody can see, and this is 2019. Let's go back even further. And then just look at this. I mean, these are the drops. People forget this. People forget just how bad it got. Let's go to a monthly chart with all of the data, and let's just look at it from this period.
2000 to 2002, it lost 81%.
Take a look at that, my
That's
friend.
devastating.
So here we are in 1999, and then you got everything. And then the problem is, after this market rallied, then it just gave it all back. And then it wasn't like it just recovered. I mean, it didn't just simply recover. In fact, the difference was, this is what people seem to forget, is how long then did that recovery take? Well, if I clear everything off, here was your sell-off. Here we are. We have like an 18-month phenomenon. Drops all the way down. You're lower than where you were. It didn't get back to these same levels until 2016. So in the year and a half that you had here, plus another 16 years here, that's only 20 years to break even. Let's put that in perspective. 20 years of breaking even. You go, oh, well, I'm all right now. Well, what if at this point you were 60 and now you were 80 at this point? It ain't all right. I'm sorry. And now people...
Sam, it actually gets a lot worse than that.
Yeah.
It's if you lose 80% of your account, you actually need a 400% return to get back to break even.
And people panic, don't they, Ryan, when markets go down? They end up selling. They end up panicking. They don't ride out the storm. But then the problem is they've also been told that they're damned if they do, damned if they don't, because, there's other places, and I don't want to name names. I don't want to put other companies down or anything like that, but there's newsletters out there, very popular newsletters out there, who say, no, holding on through any storm, we don't care when the market sells off, it always comes back. Well, that's great if you bought Amazon at $100 a share. That's great if you bought Apple when it was $11 a share back in 2008, 2009. But what about the people who didn't? That's what irritates me. It's great
if you have a 150-year lifespan.
Right? They always, it always bounces back. We don't worry about it. I'm sorry. I look at a market right now, and let's just go over and let's take a look back at the good old SPX right now. I am sorry, but I look at this chart, and I'm going to zoom in here, and wow, we're all celebrating the market's making new highs. I do not feel comfortable telling anybody it's a good time to buy that thing right now. Now they go, well, the market keeps going up. Well, you say, okay, let the market go up, but wait for a pullback, buy a dip, at least give yourself some profit, and then protect what you got. Now, that's the thing. It's just this simple buy, hold, and hope it all comes back. It does come back, but the problem is, how are you going to be? Are you going to weather that storm? And did you buy at a good enough price where you can afford to waste the time for it to come back? Because the problem I'm getting with people right now, Ryan, is they come to me and they're like, yeah, great, buy and hold. If I'd have held on, ideal world, great. But the problem is, the price they're paying now, they don't have enough money anyway to be able to afford much of the stock. Because guess what? You want to go buy the S&P right now? It's going to cost you $4,000 a share. How many people? Most people haven't got $1,000. Do you know 75% of Americans haven't got $1,000 of spare cash in their bank account right now? Here's an even scarier number for you. Apparently, and this is in the US, baby boomer generation. 80% of baby boomers today have less than $5,000 in savings in their accounts. And they had it better than anybody.
Yeah.
And this is why I feel like people have got, and I do get quite passionate about it, but I make no excuses about it. And I'm like, guys, you know, what if we get a sideways market for a long period of time? Isn't it important to look at something else? And that's where using these ETFs, forget even about futures trading, having real diversification is going to be key, you know, knowing when to take a profit, because to me, it's just stupid to sit through all the ups, all the downs, all the ups, all the downs and say, well, look, I'm higher now than I was here. Yeah, but you could have took some profit here and got back in. You could have took some profit here and got back in. And you would have actually done a lot better. You would have had more of a straight line of growth that way. But people have been told that's not the way to do it. Why are they being told that that's not the way to do it, basically, you know, when we see this? And, you know, this is what I was showing you on the charts here, you know, these things. Tell me, Ryan, why are they not being told that?
You know, there's more than one reason. I think a lot of it is the person telling them that just doesn't know how to invest better. Yeah. They don't know themselves. And because they've been taught by someone who doesn't know themselves, usually the people that are telling their clients to invest that way are not the actual investors. They're the salesperson, not the investor, because investors don't actually invest that way. They just don't. They protect their money. The good ones do. Let me put it that way. The good ones protect what they have. I give you this analogy. It's kind of like this. Let's say we're in a boxing ring, right? And here comes a big Mike Tyson right hook. Bam! Knockout, right? Anyone takes Mike Tyson in his prime too.
Yeah, right.
They're going down to the floor, right? So that's like, you know, the NASDAQ from 2000 to 2002, that 80% drop. That's a knockout. Like, you're done. That's it. Game over. You're not going to recover from that. You need a 400% return just to get back to break even. I think you said you took about 20 years just to get back to those highs. And people they don't have that kind of time. They don't have time to mess around. That's a knockout punch. What would be much better is to get the right either allocation to protect yourself better, the right training as far as a boxer goes, and even go tactical on it and say, look, I'm going to use some different tactics than just standing in the ring and letting Mike Tyson knock me out.
Yeah.
I'm going to bob and weave. I'm going to float like a butterfly, sting like a bee, right? I'm going to move. I'm going to run around the ring if I have to.
I'm not going to let this guy just hit the seven shades out.
I'll do what I got to do, right? So you'll train for it. So that way you'll take a punch, but you won't go down. It's not a knockout. You'll stumble a little. You'll lose your balance. You'll lose your footing. You might that hurt, but no, you're still standing. And you can go the distance, you can go the rounds. And that's what we're doing here in the Wealth Wednesdays is, look, I will show you how to go the rounds with a Mike Tyson in the ring. I'll show you how to take a hit in the market and survive it. Yeah. Not only survive it, but be able to thrive when you come out of it. You know, and it's like, it's there. It's there. It's just people don't dig enough to learn how to do it. At least that's been my experience. Anyway.
Or they, and again, I'm not here to slag anyone off, but they get a Robinhood app, they put $500 in it, they click buy button, they make a little bit of lucky money, and they think, oh, that's all it's going to take. You know,
and that's one of the worst things, because that's what happened to me. In fact, when I got started, I bought Dell Computer in 1993, and the thing went straight up.
Oh yeah.
And every time
why have I been doing this for years?
Yeah. Every time I did a stock split, I bought something else. I bought Cisco, AOL, AMG, CMGI, E-Trade, all of these, explosive, and they all went straight up. I made a ton of money without knowing what I was doing, man. I didn't know. I just knew to buy, and the thing went straight up. But I didn't know what I was doing. And then in 2000, when you pulled that chart up, the NASDAQ went down. Well, guess what my assets were in? What stocks I had? They were all NASDAQ.
That's right.
I think the only non-NASDAQ one I had was Home Depot. And even that went down.
In a major market panic, it all gets hit, doesn't it?
Yeah, it does. It really, and my ego got hit too.
Yeah. I mean.
And so that's really when I learned, I'm like, hey, there's something to this here I got to learn. There's something I'm missing. I got to figure this thing out. And then that's when I really started to dig deep and learn. And it's unfortunate that that it takes a big loss like that for them to actually move forward and learn how this game really is played.
It's usually just the way it is, though, And,
I think that's a lot of things in life.
I think I've always said to you, the problem is it's so accessible now. I mean, it was accessible before we had apps doing it, and it scares the crap out of me thinking about trading off of an app anyway. I use computers. I have multiple screens. I take it very seriously. But you know what? This is the problem. There's no gateway to entry. Like I say, if I decide that I want to be a doctor tomorrow, I don't go to my local hospital and say, hey, can I join surgery tomorrow morning and do some shadow work, yeah? I'll just turn up.
I watched a YouTube video on a brain surgery.
I'll bring my sandwiches. I'll bring my own salad. You don't have to pay me, but I'll just hang out the back. You know, I'll put my scrubs on. I'll look over your shoulder and give me a couple of weeks and, yeah, I'll do what you want to do. Is that okay? I'll get locked up. But you know what? It's the way it is, and it's never going to change. And, you know, people, I want to do it right or they don't want it wrong. They want to get the help or they don't. Either way, you know, for the people who want the help's there. If you're people who want, good luck. I don't really care. The point is, I'm very passionate about this. I just think people should take an interest in it and see that there is a different way. What I would love to do is to share these slides, you know, Ryan, that you kind of put together. Because just for all the viewers at home who are looking at this right now, you put together some great stuff for us here, which I'd really, really like to share. So let's go on over to the desktop so you can probably see this now, Ryan. Yeah, so we went through all of these categories. Let's go to it and see what else we've got on here as well. So you also put together something really good, your top 25. So this top 25 list of ETFs that we're looking at right now, this is by volume, right? So average daily volume, would we say on this, yeah?
Yeah, this is really important to me because I trade a lot of ETFs, like swing trade, and also when we're doing our asset allocations, tactical allocations, so on, and those type of things, we use these ETFs. But it's very important that we use ETFs that have a lot of liquidity, have a lot of volume.
Yeah.
Because we need to be able to get in or out anytime we want or need to.
Yeah.
And we don't want to be at the mercy of that market. You know, if we want out, we want out. We want out now for whatever the reason may be. But,
what I like about this as well, Ryan, which is really, really neat, I feel as well, is what we've got here is, you know, you've got the Ultra Pro short Qs.
Yep.
So that's a way that you could actually get short on the market by actually buying something, correct?
Right.
That's a great vehicle for somebody in a cash account as well. Look at your diversity though. Look, you can still diversify by having your bonds on here. You know, you've got your gold trust iShares. You know, you've got
emerging markets, number
gold
10.
Miners,
you got,
the Russell.
All kinds of good stuff.
I love this one. Actually, this is a great. The EM, I've done a lot of options on that. Because that's done well. This top 15 here as well, including SLV that we've got on here, XLE Energy. A lot of these have a ton of options. Open interest on them as well, and volume for you to actively trade as well, which I think is really good. So these aren't for just buy and hold. You can do a lot of options plays on this as well, can't you, Ryan?
Yeah, absolutely. And that's another reason why I'm looking at those. And the next slide is more specific to options. So this one's just highest volume, you know, by the actual ETF. The next one is the most active options on those ETFs. So they'll be high volume also, but it's more specific to options.
All right.
And for someone that trades options, like I know you do, myself, a lot of us at StockAbility, we trade options. And so that's a real big one for us. We want to make sure that the stock itself or the ETF not only has good liquidity, but the options market has good liquidity too.
These are great as well. I've just put a little highlighter on here so it's easier for people at home to see as well, and what I'm pointing out, as well as marking off some things. You also put together another little list here for us, Ryan, as well as the most active ETF ones. Okay, so how is this different, the most active ETF?
Yeah, so that's the options one. That's the most active ETF specifically for options.
Beautiful.
So not necessarily for the volume of the ETF itself, that average daily volume.
This is the actual outright ETF shares, because ETFs are just shares. Right. This is the trading volume, but this is the options volume, the contracts of options on here, which is huge. Oh my! Look at the spiders. I mean, let's just
no surprise there, right?
Look at that, 4 million a day. But I mean, look at the level of diversity. You've got the big ones in, like say a real big one on here as well. I love it. This is what I love. I love this one here, emerging markets ETF. What a great safe way of doing it as well. GLD, ironically, up there, much higher on the active ETFs, okay, for options trading volume, but not necessarily on the actually outright as well. But again, just a great level of diversity. The EAF shares. Now that's if I believe that EAFE. That is actually like the global index, isn't it? That's the overall, that to me, I love this one. I'll just highlight this for everybody that I'm just looking at here. This EFIA, right? The EFA, the EAFE Shies Morgan Stanley ETF. That is actually, if you like, and again, I'll just highlight this one I'm here. I love this one. That's like a global index, isn't it, Ryan? That's the best way of pretty much describing that. I love that.
That'll get you, one of those regional type of ETFs out there.
Yeah.
And on that list, there's actually a couple niche ones on there too.
What else have you got here?
Let me see what number is that here. Look at number 22.
22. Global Clean
Energy. There's a niche ETF right there. That's what I was talking about, the niche category. So if you're into the clean energy, like a solar, wind, things like that, then that would be companies specifically in that industry.
And I think more than enough volume in all of these things for anybody who's interested in getting involved in this, wouldn't you say?
Yeah.
More than enough volume on there as well. I absolutely love that, Ryan. You also shared this information where you got high dividend ETFs. So this is people who are looking for get a little bit of income, right? This is what people are looking for. Yeah,
these are dividend ETFs. Dividends they've been popular for decades. So there's always someone interested in dividends out there somewhere.
They got a load of money and they can buy a load of shares.
Right.
The ROI right now on a lot of prices of these isn't great, but the problem with dividend investing, guys, I've always found, for the average investors, if you haven't got a lot of money, you need more of the share to get the dividend. But some of your, people working with maybe high 6-7 figure accounts, there's still money to be made out of dividends, right?
There are. I want to have a word of caution on this though. Those dividend yields, it starts at 24.55%. Now I look at something like that, I'm like, who wouldn't want that?
Right.
Well, we need to go investigate first.
Why is it
because there's something going on that might not be quite right. That company might be in trouble, and so investigate.
Yeah.
Don't just say, hey, I'm going to go high yield and that I'm just going to invest only in that. No, they're high for a reason. Investigate what's going on with that. Is it really a sound company or ETF, that represents sound companies? And if it is, great, you found a real gem there, and that'd be a safer investment there and to get some dividends. But there's lots of different ways to get dividends. And
absolutely.
That's just one way. There
and then finally, you put together on here some of the higher fee ETFs as well.
Yeah,
right?
And this is something everyone needs to be aware of. If they do decide to go the ETF route, which I highly recommend, that it's a great way to go. It's a better mousetrap compared to the mutual fund industry. But ETFs have fees also.
Yeah.
And so this is just to show you a list of, hey, look, be aware. They have fees. Some of them, 2-3+%, which is getting pretty high for an ETF. Most ETFs are going to be 50 basis points or less. That's half of 1% or less. And if you look at like the Vanguard ETFs, they have the lowest fees of anyone out there.
Right.
So they have some really good ETFs, good liquidity. A lot of them you could trade options on, and very, very low fees for those they're going to be in it for the long haul.
Question for you, Ryan. Are the fees done for somebody who's only holding these positions for a short period of time? Is there a holding period for these as well that people could be aware of, for when those fees kick in? I mean, if you were just to get in and out within a day.
Usually they're monthly. They're prorated monthly for the most part. You have to look it up, because I would say it would depend on the ETF. They might prorate it daily, in fact, some of them. So it's just something that someone would have to look up. And Yahoo Finance and Morningstar or whatever, these kind of companies you can look up and under the fee section and see what they are.
Okay. It's good to know, though. Again, these are all important things done. Let's just go to the last kind of things you put together as well for us, which I think this is awesome. So you talked about this earlier on. You want to explain a little bit about what we've put together for the guys here?
Yeah, this is actually really important. This is more not for the trader, but for the longer term investor, whether it be an active investor or even more of a passive investor. What this basically is there's 4 different situations that can happen in the economy. You could have inflation, you can have deflation, you can have economic growth or economic decline. And these quadrants that you're seeing here are basically what is happening in the market environment. So you could have let's just take the upper right quadrant first, inflation and economic growth. So if you might have a situation where it has that. And then maybe a few months or a year or so later, you actually have deflation and economic growth, the lower right quadrant. The lower left quadrant is deflation and economic decline. And then the upper left is inflation and economic decline, which is what's called stagflation, which that's not going to be good for the economy.
No one wants that.
we don't want that one.
Stay
away from that one. Stay away.
Everything's getting way more expensive and no one's got any money.
Yeah, exactly.
Yeah,
so
that's kind of scary. We play for that where we don't that $100 loaves of bread and all that kind of good stuff.
Yeah, exactly. Yeah.
Gosh almighty, yes. We pray that doesn't happen. Okay, so then does this relate then to our specific can we find a more specific ETF strategy with this in mind?
In fact, yes. So go to the next slide here, and it gets even more specific. So if we're in a particular quadrant, for example, let's just take inflation and economic growth. if we're in that particular quadrant, then that would benefit something like equity. So SPY, QQQ, pretty much any of your equity markets. Okay, so that would be a good one for that. If you have deflation and economic growth, equities would still benefit, just not quite as much. So that'd be more like established companies, like your Dow Jones Industrial Average companies, your SPY, your S&P 500 companies. So maybe not quite the traditional growth-oriented companies.
So let me interrupt you for a second. And would we say that this then definitely, we talked a lot about this growth. This was a big debate right now, growth stocks versus value stocks. This for me would be that growth, I feel, period.
Correct.
To be looking for that, which definitely is what I feel we've been going through anyway, from the way the market's been acting. This is probably best your value stock period. So a lot of those more staple companies as well. So, maybe things that the market still got slow growth, but there's going to be those companies that are not going anywhere that everybody needs. Would that be a good way of looking at it, Ryan?
And value could also even be after an economic decline too, and that's usually where you pick up the really good, value. deep value. Deep value.
Markets
you'll get after that economic decline.
We're talking companies now that are going to feel a pinch but ain't going anywhere.
Right.
We're going to need them. So that's a really great way of putting it for everybody. I love that, Ryan. Okay, so what about over on our decline then?
Yeah, so if the economy is declining and there's deflation, you're looking at long-term bonds like TLT would be an appropriate ETF for that. Mm-hmm. And then if you have inflation and economic decline, then you're looking at gold would be pretty much either gold or gold. It's not much there really. It's not a whole lot we can do in that. Let's put it that way. If it gets to that quadrant, you're better off being a trader, not an investor.
Maybe with some of those inverse. Maybe though, again, we could still use those inverse ETFs right during that period.
Sure,
would that be an option for us?
That would be an awesome option for us. In fact, that would be a great solution for really any of those four quadrants.
Wonderful, man. That is just like super, super helpful. I mean, I love that. I absolutely love that. I mean, it's just. Yeah, it's such a great way of putting it. I mean, this can be such a complex subject for so many people if they just don't know what they're doing at. But what a great way of breaking it down. I love that. And I'm such a big fan. I'm just such a big fan of ETFs, just for their pure diversity,
Me too.
Right?
I really am. You can day trade them, swing trade them, long-term invest. I mean, you name it. So flexible.
If you take anything from today's interview, for today's discussion, it's not really been an interview. It never is an interview with you, Ryan. It's just a great discussion. ETFs are a great vehicle. And remember, you can trade them outright or you can do the options on them. I hope you found that helpful. And again, I'm sure we're going to get a lot of hits on this about just using ETFs for what I call true diversification. Ryan, I'm looking at the clock here, and it wouldn't be TakeStock Live if we didn't do your call, my put. What have you got today for us, my friend? Your call, my put. You're feeling bullish, you're feeling bearish. You are allowed to be neutral on this as well if you want to.
I'm actually going to be bullish and bearish.
Well, how can that be possible? That's called sitting on the fence. Make sure you don't get any slip.
No, I'm committed
splinters
to
in your backside,
directions.
All right?
I'm not sitting on the fence on this one. I'm committed to both. So I'm actually going to be short or bearish.
Are you giving us a double opportunity here then? Are you giving
I think that's what it's coming down to.
Go on. I'm not going to interrupt you.
So I'm going to be bearish US dollar, bullish euro.
Okay, right. So let's go take a look. So I'm going to put up the euro dollar. You want me to pull up the dollar index or the euro first? What would you like to say?
Either one works. Yeah, it's kind of just it's the opposite. So, the euro, it's sitting in a really nice monthly support area.
Oh, and I can see why you're sniffing around. Like, ladies and gentlemen, right now what we're looking at here, we are in this major uptrend that we can see right now on the dollar index. But this is a daily chart. So let's look at this weekly chart. And I think one of the things that Ryan's highlighting here is, yes, this is getting a little bit dicey for that dollar right now, I'd say. And again, you can also see a similar price action on that. Also, if you look at the chart over here on the left-hand side, which is a monthly chart, is that what's giving you a little bit of caution there, Ryan?
Absolutely.
Yeah.
Absolutely.
So we're anticipating a little bit more downside on the dollar at the moment from where we are. I think the dollar's, again, holding up better than I would have expected as well. But again, to me, I think with the currencies, we're just in this period of indecision, just flows in and out, in and out, in and out. But definitely a lot of pressure. So that inversely means if you're bearish on the dollar, you're bullish on the
Euro.
All right, let's go take a look at that euro then right now. Let's pull that up. So I'm going to go and grab that chart, EUR-USD on my platform. Here we go. Oh, look what I have marked off on the charts already. Here we go. Like, I guess you're talking a little bit about this. And again, let's just zoom in for everybody at home so they can see a little bit more of this. I see this area right now. Let's actually kind of just activate this drawing tool so I can see it a little bit clearer on here.
Taking a bounce
there
off
it is,
right
really.
Now. There it is.
It's in a buying opportunity right now, both on the daily. I got to say, and I think just looking at this chart, the cluster of activity I see around this area would be a great target on that. I'd sniff around 1.2 on that. What are you feeling, Ryan? Or am I being a bit too ambitious? Maybe about 119.50?
I think that'd be a great first target right there, depending, of course, on how someone's time frame you want to trade it. Another thing, the theme is ETFs. So if someone wanted to actually trade an ETF on this, you got the US dollar ETF, the UUP. So we could, someone could. That's an ETF that represents the US dollar. So we could trade that ETF, the UUP. You could do options on it as well. So there's lots of ways to trade this. There really are. You could do futures. You could do spot Forex, and you can do the ETF or options on the ETF. So you got 4 different ways.
Now I'm a little bit cheap on this, but I'm looking at this area here right now. I'm looking at this whole area. If I wanted to be aggressive on it right now, this could be a great time to be buying some puts on the UUP right now. Yeah. And the volume's there as well to do that. Just so awesome. I mean, how cool is that? Just another way. Could be buying some puts on there. Got a nice easy target to the downside.
That's a good spot for it right there.
Exactly.
Yep.
And if you want to wait a little bit higher, could wait. But even if you get your timing slightly off, you've got some great opportunity for put buying on that as well. And on the flip side of that, if you really wanted to, because we're looking for these rallies right now for this to come down with euros go up, we could be buying futures contracts on the euro as well. I mean, we could also be doing that. Yet another way to do this, which we could put the 6E in here, which is the euro futures, and we can see on here that, again, just like the same thing, these are the futures contracts on that good old euro that we could be looking at for the 6E. I look at that right now when I'm seeing on here, and if I just go back, time this off, and then just zoom in right to here, wow is what I'm saying. That euro, and you can see it's just in a great position. So, hey, take your pick. Buy puts on the dollar, okay? Buy calls on the euro, buy futures, options on the futures of the euro, or just go buy euro USD. It's up to you, but there's many ways to slice the bread, as Daniel Bustamante, our partner in all of this, says as well. Nice. Well, you know what? This actually ties up quite nicely because I was going to do a bullish play today. Okay, which I rarely ever do because everyone always wants the bullish plays and they always give me those. But I was actually getting pretty bullish on, let's bring it up and show you, gold, which actually would line up right now. The move's already kind of underway, but I don't think we're too late. This is kind of a long-term play, but I gotta say, looking at these charts, it is a little bit aggressive. I'm more playing on this. This is an aggressive bullish play. But right now on here, I see that we are getting some serious buying pressure. I like the fact we're forming a bit of a double bottom on the chart here as well. You see this double bottom play that we're going? I wouldn't want to buy it now, but I am seeing a ton of upside potential on this particular market. So to be a little bit more, let's zoom in a little bit more so you can see this particular chart on here. Here's my major support area. I need a pullback on it, but there's one or two ways. I'm either going to wait for a slight pullback on this market, probably somewhere to around 1700. This is a longer term play, and then expect it. Another way I could do based on the location is maybe GLD. We could be buying calls on GLD. There's plenty of option volume on GLD, as we just looked at in that slide you put together for us, Ryan, as well. So I could be buying some calls on that, which is another way of doing it. Or, you know, I might just wait for a kind of a breakout signal if this market breaks higher from this area, because to me, $1,800, maybe $1,850 at this point, there's definitely room to go. That would line up quite nicely, wouldn't it, with the fact that obviously
you got a lot of upside potential on that. We've been looking at that weekly level even before it came into it in our GTS swing trading session. So we've been eyeing that one for quite some time and monitoring it and trading it and the whole deal. So that's a good spot, that weekly support zone there. Very
cool. Well, plenty of different things to talk about there. Plenty of different things that we've got on there as well. What I'd love to do before we end the show, Ryan, is just talk about what we've also got coming up over at StockAbility. Ryan, you've been having this great vision of putting together kind of an online summit, conference, gathering as well, which we finally kind of got on our schedule as well. So what I'm going to do is I'm going to go over to the website. I'm going to let you join. You're in here in the middle. So I'm actually just going to make sure we take ourselves out of this as well. But if you scroll on the page, you'll see on here, this is our website. So let's just go over to just do the desktop only first on here. Scroll on in. Head over to StockAbility.com. That's the website. And if you scroll down to the bottom, you will see on here, actually, that's great. Hey, look, fancy new Trustpilot reviews on here, which is really, really good. There's our smiling faces. Just did a webinar this week. We've got 2 company webinars coming up on here. First one we've got is on Wednesday, April 7th at 5 p.m. Eastern, 10 p.m. London time, which is trading from side hustle to full-time income. We're also repeating that again on Tuesday, April 20th at 5 p.m. just to accommodate people in different time zones. But what I'm also really excited about is kind of your brainchild here, a special one-day event enhancing your trading and investing performance. This is a 10 till 4. Let me zoom in so you can see it. Wednesday, April 20th, 10 till 4. What's your vision for this, my friend?
Exactly as it says. Get people the trading and performance, trading and investing performance. Show them ways that they can do that. And there's lots of different ways. It could be technical, fundamental, psychological, emotional, educational, you name it. There's a lot of different ways. So that'll be the big focus there, is helping people get better performance in their trading and investing.
Awesome. I'm super excited about that. We got a whole host of people going to be joining us on there. You'll be speaking, Dan will be speaking, I'll be speaking. We've actually got one of your own performance coaches coming on to the expo as well. A whole load of great things that we've done here. If you want to find out more about what we do at StockAbility, that is the place definitely to go in that respect as well. So I'm super excited about that. Ryan, it's Easter now, special time of the year. You taking some time off with the family and all that good stuff?
I am. Yeah, we're the car is packed.
Where are you
heading? As soon as I'm done here, we're gone.
All right. And where are you heading off to?
We're heading up to Kentucky. We got some family up there, some sights to see, and so we'll take a little tour there. So
beautiful.
But, we've never been up that direction, so it'll be nice.
Wonderful. Well, I'm going to wish you safe travels, restful time with the family as well, and thank you again, sincerely, for an awesome show. Some amazing information. I'm super grateful. Our viewers are super grateful as well. Ryan, let's have you back on the show in a couple of weeks, okay?
Thank you, Sam. Appreciate it. God bless everybody. Happy Easter. Bye-bye.
Ladies and gentlemen, that was Mr. Ryan Watkins, lead coach at StockAbility. Always awesome having him on the show, talking diversification through ETFs. That's definitely, out of all the shows we've done here, one to probably look at the recording of. Remember, when this show ends shortly, you are going to be able to look at the replay of this here on the Facebook Live StockAbility page, or an alternative is later on today, you will see all of the previous shows, including this one, all available for you to look at as a catalogue on the YouTube page as well. As well as subscribing to that YouTube StockAbility page, you'll see plenty of lessons every single day coming from our team as well. Tips, tricks, and actually we show you a lot of our trades as well and what we get up to too. So a lot of very, very cool things for you guys to be looking at as well. If you are interested in more about what Ryan was just talking about on here, let's just go back over to the website again so you can see. Head on over, my friends, to StockAbility.com. And when you go to StockAbility.com, scroll on down to the bottom of the page here and you'll see in big gold letters, register for a complimentary webinar. We have 2 webinars coming up, Wednesday, April 7th at 5 p.m. Tuesday, April 20th at noon Eastern time as well. But what also we're super excited about is this I'm going to highlight right here, our special one-day event, which is enhancing your trading and investing performance. This is all about basically overcoming all of the stuff out there that you have trouble with. Why do so many people struggle at this? How do I avoid the mistakes that others make to take my own trading to another level? If you don't want any BS, if you don't want any voodoo, if you just want to know to the point, how do people just really make this simple and just get in there and do it without all this fancy out indicators and chart patterns and, cutting all of the stuff that you don't need out there? Join us for that special one-day event and we will start to peel back the curtain and show you a little bit more about what we do. We'd love it if you could join us. We will welcome you with open arms, my friends, as well. All right, this is the end of the show here. It's just a little after 1 p.m. Eastern. I'm going to wish you all once again a super happy, healthy Easter. You guys in Europe, enjoy your 4-day weekend. We're not having that here, but we are recognizing this very important special time of the year for everybody around the world, whatever religion or denomination you come from as well. And special time of the year. Stay safe. I hope it's getting warmer where you are in the world as well. And remember, tomorrow the market is shut, so don't look at the charts. Take a day off. And also, volume is probably going to start winding down a little today. So Monday, hit the ground running, see what it's all about. And until then, we will see you this time next week here on TakeStock Live. I'm Sam Evans. It's just after 1 p.m. here. Thank you so much for joining. I'll see you at the same time next week. Have a good one. Take care.